Our investment team has developed a tool we call the Economic Dashboard. This dashboard helps us to visualize our opinions on the investing landscape. It helps determine whether conditions exist to facilitate good corporate earnings growth and economic activity. With a little bit of explanation, it's fairly easy to read. Let's have a look. The outline of our dashboard looks similar to a spider web. We can map various data points on each line emanating from the center. On this chart, we have 11 factors that we believe are essential in evaluating the sustainability of growth as we look into the coming years. On the right hand in green are 6 economic indicators which measure economic growth, inflation, and various aspects of the U.S. labor market. On the left in gray, we have 5 risk indicators, such as bond defaults and recession probability. For each of these data points, the best place to be is on the outer edge of the chart. The red indicates a measure that is out of our comfort zone. The orange line connects each data point and paints a picture, if you will, of our overall sentiment regarding the economy and risk. As an example, this chart shows where conditions were in June of 2017. In January of 2007, the dashboard looked quite healthy. However, the housing crisis had begun to affect the U.S. financial system. An early warning sign came from Freddie Mac in January as they pulled back from any future subprime mortgage purchases. By July of 2007, layoffs in the mortgage industry began to affect momentum in the labor markets. We also see our first hint that the housing crisis may be negatively affecting the financial system, with 2 of our key systemic risk indicators moving toward the center. Despite the growing crisis in the housing sector, the stock market continued its steady climb, reaching an all-time high in October of 2007. By this time, several indicators were flashing warning signs. Most concerning were those signaling increased financial system stress. By January of 2008, it was becoming clear the housing crisis could have widespread economic implications for the U.S. and potentially the world. The S&P 500 had fallen by 10% by this point, however remained close to all-time highs. In June of 2008, federal regulators seized IndyMac Federal Bank, and by September had taken over Fannie Mae and Freddie Mac. Lehman Brothers filed for bankruptcy court protection, and the insurance giant AIG accepted an $85 billion federal bailout. Goldman Sachs and Morgan Stanley, the last 2 independent investment banks, were forced to become bank holding companies subject to greater regulation by the Federal Reserve. By this time, the S&P 500 had fallen 25%, and it was clear the U.S. economy was headed for a recession. Between mid-2008 and March of 2009, several major banks would need to be rescued by the FDIC and the Treasury Department. On March 9, 2009, the S&P 500 reached a low for the crisis and was down over 50% from the 2007 high. It was one of the worst stock market corrections of all time. This is about as bad as our economic dashboard can look. However, by the end of March, there were signs the financial system was starting to improve. By the end of June 2009, financial stress indicators began returning to normal, and by September of that year, we saw improving momentum from the labor market and some leading economic indicators. By the end of 2009, the U.S. economy turned from contraction to expansion, and companies began posting positive earnings growth once again. Bank lending was slowly returning to normal as conditions in the credit markets improved. It would take the next several years for the U.S. labor market to work off the high unemployment levels. Growth was positive but below average. The Federal Reserve left monetary policy at highly accommodative levels throughout this long recovery process, helping both businesses and consumers refinance existing debt at low interest rates. By 2013, the stock market would set new all-time highs. Confidence in our financial system had returned. The Economic Dashboard is one of many tools we use to keep our fingers on the pulse of the economy. While the next market crisis will likely not look like the last, it's our expectation that tools like these will help raise some red flags before it arrives. Thanks for watching.